you ever wondered why some people seem to build wealth in the stock market effortlessly, while others lose everything chasing quick profits? It's not luck. It's knowledge, discipline, and strategy. In this course, you'll learn to read the market like a pro, from understanding price movements to mastering trading psychology. Stick around till the end, because the final chapter will teach you how to think like the top 1% of investors. These are the ones who turn patience into profit and knowledge into freedom. Before you buy your first stock or even open a trading app, you need to grasp one key concept: what the stock market really is. The stock market isn't a casino. It's a marketplace of ownership, built on human behavior, value, and time. When you buy a stock, you're purchasing a small piece of a company, and that company's success determines your profit. But here's the twist. Stock prices don't always reflect a company's real value. They reflect what people believe that value is. That's why prices move, not just because of earnings or news, but because of emotions like fear and greed. Now, there are two main ways professionals analyze the market: fundamental analysis and technical analysis. Fundamental analysis focuses on a company's financials and long-term value, while technical analysis studies charts and price action for short-term predictions. Both are crucial. Long-term investors lean on fundamentals, while traders rely on technicals. And the best in the game? They understand both. Think of it like building a house. Fundamentals are the strong foundation, while technicals are the windows that let you see daily movements. Master both, and you won't just survive in the market, you'll thrive. Let's talk about investing, the art of making your money work for you while you sleep. Every millionaire investor started with the same question: how do I grow my wealth without gambling it away? The answer lies in three timeless principles. First, time in the market beats timing the market. Don't try to guess tops and bottoms. Invest consistently over time. Second, diversification is key. Don't put all your eggs in one basket. Spread across sectors, regions, and asset classes. And third, compounding is your best friend. Reinvest your returns so your profits begin generating profits. That's how small amounts can become fortunes. Imagine if you invested $100 a month into an index fund for 30 years. At an average of 8% growth per year, you'd end up with over $140,000. That's the magic of compounding. Quiet, invisible, unstoppable. But don't just invest blindly. Study what you buy. Warren Buffett once said, "Never invest in a business you don't understand. Learn what the company sells and understand its competitors. Watch how its leadership behaves in tough times." Because when fear hits the market, and it always does, knowledge is what keeps you calm while others panic. This is the investor's mindset. Play the long game, focus on value, and let time be your partner, not your enemy. Now, let's dive into the fast-paced world of trading. Here, timing is everything. Emotions play a huge role. Precision is key. Trading isn't just gambling. It's about managing probabilities. No strategy wins all the time. The secret? Control your losses and focus on high-probability setups. Let's break down the professional framework. Market structure is crucial. Every price move creates patterns. Higher highs and higher lows in an uptrend, or lower highs and lower lows in a downtrend. Remember, the trend is your ally. Trade with it, not against it. Support and resistance are the market's invisible walls, levels where price tends to reverse or pause. Professionals mark these zones before every trade. They're essential for planning. Indicators and confirmation are your best friends. Use tools like the EMA, RSI, and volume indicators to confirm your bias. Don't rely on just one signal. Look for confluence, where multiple signs agree. Imagine this. You're analyzing Apple stock on a 5-minute chart. The price hits a strong support zone. The RSI is oversold, and your EMA cross is turning upward. That's not luck. That's strategy aligning with probability. That's how professionals operate. But here's the part many beginners overlook. Risk management is vital. Never risk more than 1 to 2% of your capital on a single trade. Even the best traders face losses sometimes, but they survive because they protect their capital fiercely. Trading isn't about being right every time. It's about staying in the game long enough for your edge to pay off. Remember this: amateurs want to be right. Professionals want to make money. Every trader faces an invisible opponent. It's not the market, it's emotion. Fear and greed move charts faster than any algorithm ever could. You can master every indicator and candlestick pattern, but if you can't master yourself, the market will teach you humility. Professional traders follow a mental code. Detach emotionally. Don't celebrate wins too much, and don't mourn losses too long. Treat both as data. Plan every trade. Know your entry, exit, and stop loss before you click the button. Discipline is stronger than instinct. Accept uncertainty. No one controls the market. Your job is to manage risk, not predict perfection. When fear whispers, get out now. Breathe. When greed shouts, double your position. Breathe again. One calm breath can save your account and your confidence. Keep a trading journal. Write every trade, why you took it, how you felt, what you learned. That journal becomes your mirror, showing patterns you didn't know you had. Most traders lose not because their strategy fails, but because their emotions hijack their strategy. So master your mind first. Once your thoughts move slower than the market, you've already won half the battle. Now that your psychology is strong, let's dive into professional strategy. Every elite trader follows 3 key pillars: analysis, execution, and evaluation. First up, analysis. Use a multi-time frame approach. Start from the daily chart and work your way down. Identify the trend, key zones, and momentum. Then zoom into lower time frames for precise timing. Whether it's stocks, crypto, or Forex, remember, momentum is a wave. Don't fight it, ride it. Next is execution. Great trades often feel boring. No rush, no panic, just clarity. Wait for confirmation. Price reaches your zone, indicators align, and volume confirms. Then execute without hesitation. Doubt after entry can kill more trades than bad analysis ever will. Finally, evaluation. After each session, review your trades. Mark what worked and what didn't. Reflect on the emotions that drove your decisions. Improvement is born in reflection. And here's an advanced principle: position sizing. Calculate your lot size by risk percentage. If your stop loss is 2, never risk more than 2% of your total capital. That's how you stay consistent. Remember, professionals think in series of trades, not single outcomes. A losing trade doesn't define you. A disciplined process does. Now you've learned the structure of the market and the psychology behind it. But here's the secret. Trading isn't just about money. It's about becoming the person who deserves to win. The charts will test your patience, losses will test your courage, and profits will test your humility. Through it all, the real reward isn't the number in your account. It's the strength and clarity you build. Every great trader started where you are now, uncertain and hungry. What separates them is the decision to keep learning. So as you close this course, remember, markets rise and fall, but discipline and self-belief compound forever. Your financial destiny doesn't begin with your first trade. It begins with your mindset. Open your charts, your notebook, and your belief in yourself. The next bull market isn't just in the economy, it's inside you. This is your time. Trade wisely, invest patiently, and build the life you were destined to live.